Welcome, everybody. Welcome. It's 11:30, and I'm excited to welcome everybody to our framework for empty nest parents, helping out our adult children. And the framework that we like to build around this is what I call a permission to help. So we can find a way that we can actually help our adult children as they're aging out, developing their own future, their own lives, and ways that we're involved in that we want to be, maybe ways we're involved in that we don't want to be. And how do we handle all that, the pressure, the tension, the back and forth of all that? So our kids are grown, but they're not always financially independent. And because of that, many parents feel guilt. They might feel some obligations and even a little bit of fear at some time. So what I'd like to do today, if I can, is help normalize that tension a little bit. The tension between us really wanting to help, but also not wanting to derail our own future plans. When I wrote the book, Empty Nest, Full Pockets, I talked about imagining life with a little bit of you back in it. This is a great example of that. We're getting to a point in our lives as empty nesters or as pre-retirees or even in retirement that we've got to plan for our future. In many cases, a very long future where we're going to be, not working and doing things differently for 30, 40, 50 years in some cases. So imagining that life with us a little bit back in it is very much a challenge right now. All right, let's kick things off here. Okay, so do our disclosures. All right, so who am I and why am I talking about this today? My name is Matt Moline. I am the founder and CEO of Prairie Fire Wealth Planning in the south side of Des Moines, Iowa. And I actually have 4 children. All of them are adults. This is a picture taken this summer from my son Matt Jr.'s wedding, where we had all of them in the same space, which is very difficult to do anymore with them all over the nation. But we've had 4 adult children, put them through school. They're all out doing their adulting experience, all with different levels of success and also different levels of challenge that comes from all of that. So when we talk about this experience today, I very much have my own experience. The other thing is that we've helped hundreds of families throughout the years as they've dealt with the transition of a full-time working life to becoming an empty nester to getting ready for retirement, and all along the way dealing with the challenge that comes with these years. And so really the goal for today is I want to help you with some clarity, help you find some clarity in this transition, that you're making the right decisions and how you can have that clarity instead of anxiety. If you are in the empty nest years and you have 4 adult children like I do, probably what you're experiencing is what many term the sandwich generation. So what's going on is that we're sandwiched between what our kids need and the challenges that they're facing and are wanting to help and are wanting to fix the things that are going on in their life. And then we also have, in many cases, aging parents that are also having their own challenges and they're needing us more and more as well. So we got into this stage of life thinking, wow, I'm going to be, things are going to free up a little bit here. I'll have a chance to really focus on my future. And all of a sudden we have these other tug of wars going on that are causing us a little bit of anxiety, a little bit of challenge on that. So we want to address those and talk a little bit about why they're different now than they used to be for all of us when we were growing up. Talk about some of the permission to help framework around saying yes and saying no. And also just acknowledging the fact that this is a challenge and putting some real concrete financial steps behind this that I really, really hope will help. All right, so in 2026, things are different. We really have a perfect storm that as parents that we're facing. We have adult kids that are dealing with student loans, housing affordability, in some cases delayed careers. We as parents then are dealing with, we're in our peak earning years. We're also facing then peak financial pressure in that we are thinking about our retirement, our future, the ways that we need to save. We know it's kind of go time. We're getting to that stage of life where we don't have a lot of years in front of us to make some of these decisions. And so while we have this pull that we need, our kids need our help, we're also looking at, we have a lot of pressure here because used to be we had 20, 30, 40 years in the markets and or our working span career where we could make up for any mistakes maybe that we made along the way. And that time frame is getting smaller every year as we get closer to either wanting to retire, change careers, whatever may coming on. So we've also got retirement timing risk. Are we going to make that decision at the right time? We've got a lot of market uncertainty. While the markets have been great the last number of years, we know that always doesn't last. Many of us on this call remember the global financial crisis of '08. We remember the tech mess in 2002 and all the complexities in the middle of that. We've also got an ever-changing tax situation, and that can always be, a real challenge. And so what I talk about in 2026, our kids have different challenges. We have different challenges. I'll just share with you, when I got out of college, I went to the University of Northern Iowa, graduated with a degree in finance. I got a job right there in Cedar Falls, Iowa, at a bank, starting out a career in lending. And I just remember that I moved in with two of my fraternity brothers. We rented the upstairs of an old house near downtown Cedar Falls. And there was 2 bedrooms, but there was also a large closet. And so you can guess, I got the large closet because I was the third one to join the triad. And so this closet was big. I was able to put a bed in it and all that, but my rent was $180 is my point. And so even with inflation, when we talk to our kids now and they're paying $2,000 for a studio in downtown Chicago, it can just make your eyes roll, or water, one of the two. And they're facing these different challenges that we've had with inflation and the cost of housing. You know, my son Matt moved to Denver out of school and got settled there. And then as he met his mate and now his wife, they realized they really wanted to own a home. They wanted to do all the things that all young people do. And it just wasn't going to be able to happen in Denver. It was too expensive. So they've moved back here to Central Iowa to start all that. And they're going to be giving me my first grandchild here in April. So excited about that, as you can imagine. Anyway, it's a different landscape. 2026 is different in the way that it's being taken care of, and the challenges that our kids are facing, as well as the challenges that we're facing. As I got into this topic, I did some research, and I found a really good study that I'd recommend through the Pew Research Center. I also read a couple books. One's called Walking on Eggshells. It has a lot of stories about parents that were going through this transition with their kids. There's this one called You're Not Done Yet, with facing young adults into the age of uncertainty. Talks a lot about the challenges of the mid-2020s that our kids are facing. And they come from kind of a psychological viewpoint and more of how to have empathetic conversations. Today, we want to focus on some of the numbers. We also want to touch on the emotional side of this, of course, but also then some of the financial decisions that we're going to have to make as we move through this transition. Okay, so this study is called Parents, Young Adult, and the Transition to Adulthood. It was published in January of 2024. And one of the facts that they mentioned is that 71% of parents say their adult children's successes and failures reflect on the job that they've done as parents. That really centers into what the challenge of this whole situation is with our adult children, is that we feel responsible. If things are going well, we pat ourselves on the back. We say, well, I'm the greatest parent ever. Of course things are going well. If they fail, we say it's the other parent's fault. No, I'm just kidding. If we didn't have a plan for that, it reflects back to that this generation is different, and that having a plan in place is one of the most important ways we can approach this whole challenge and transition time. So some of the risks that go along with this is that sometimes along the way we have some small unplanned yeses, and these yeses can quietly create some long-term damage for us. So what I want you to consider is a mindset shift, that helping isn't necessarily the problem. It's helping without a plan that can become the problem for all of us. It's easy when the kid comes to us to just fix it and just say yes right away. But what we find is that over time, if we keep doing that, we can create some problems. So what I want to talk about next is the 5 most common ways that we unduly sacrifice our own future as parents. And some of these are focused on fix, and some of them can come with some long-term obligations as well. In a lot of cases, when we help as parents, when I studied from my research on all of this, we found that in a lot of cases, we use money as leverage in some way, shape, or form. And so what we'll do in some cases is we can help you, but we want something back in return. This is fine if we're expecting a format to give, that we expect that to be a loan versus a gift. But what they're saying isn't good is to use emotional leverage to say, well, I can do this, but boy, I could really, use this in exchange, those kind of things. So in many cases, our gifting can also come then without any expectation other than it being an open-ended gift. And that's great too. But all of these things that I've listed here is where we want to be careful. One, if we're offering leverage to emotionally expect something in return for the gift, to make sure that we voice that, or if they have some sort of ethereal leverage where I'm going to do this, but I will expect the grandkids to come over every Sunday, or whatever the case may be that we have here. So let's talk about these in a little bit more detail and how we can do them without necessarily applying leverage to the response. So open-ended monthly support is probably one of the most common ways that many of us start getting involved with helping our kids. So they have a rent payment that they can't afford because of both affordability, inability to find work, whatever the case is. So one of the challenges is if we offer this support as an open end, which means we're going to give you this support, but there's no end in sight to when this might happen. And this can be a real challenge for you as a parent, because what you can be trapped into then is giving for a very, very long time that does get you outside of your retirement plan and your future. So in many cases, when we're offering support, having some sort of backstop to this as to when it's going to end. So as an example, if you have a kid that's struggling with rent, what we did in our case is we said, well, how can you maybe find ways to generate more income? If we help in the near term for the next 3 months, for instance, one, can we do that as a loan? Two, can we do that as a way where you have a plan to where you're going to make more money? Three, can we find a different residential situation that's going to better work? What you're doing now when you're stepping in and helping an adult child is that you're becoming a mentor and a partner in the journey, not necessarily the fixer. Now, when our kids were young, we had to fix things. We had to step in and take over. It was a natural instinct, and that was good work. We did the things that were required. Now that they're adults, part of the journey is finding out and fixing their own problems. So the more that we help, the more we're delaying that journey in some cases. And open-ended monthly support can be one of those ways where if they think, all right, mom and dad have my back, I don't have to worry about making more money. I don't have to worry about the fact that my rent is too high, can cause a lot of angst for both parties. So I've seen this whether it's on car loans and or mortgages where there is a default, the kid can't make a payment, you're having to step in, or they're not making payments and you don't know it, and all of a sudden your credit's been damaged. So a lot of risk with this. We've seen a lot of folks, instead of doing a cosign loan, buy a car outright and keep the loan in their name and expect the kid to pay them back directly, so they never have the risk of having their credit damaged. When I went to buy my first car, I was just fresh out of the University of Northern Iowa, had a job, and my dad, to his credit, went with me, helped me through the whole process, worked with the dealer, salesperson, taught me all about how that process works, learned a ton from him. When it came time to get the loan for the car, he made it very clear to the lender that he was not going to co-sign. This was an obligation that I needed to take on my own. If I couldn't qualify it on my own, then I wasn't ready for it. So the bank thankfully was able to take me on and had me take that loan on myself. My dad didn't have to co-sign, but I learned a valuable lesson that if you can't take the debt on yourself, you may not be ready for it. So there's other ways to help with home purchases and those kind of things that we can talk about here later. The other thing that I saw and see in a lot of cases is rating your retirement accounts too early. So you're taking money out of money that you've assigned for retirement later in life. This comes with all kinds of challenges. In many cases, retirement accounts have a number of tax stipulations and penalties, so that if you are taking those funds out early, you can be penalized. You could find out that your monies, of course, will be out of the market where they can't earn anything, and it could set back your retirement in many cases for a long period of time. The other thing that people do to help kids out, especially I saw this when people were helping pay for college, is taking loans against your 401k plans. So just understand that when you're doing that, you're getting the money out and you're not paying some of the tax penalties, but your money is no longer invested. And if that happened over the last 3 years, for instance, you gave up a big upside in market returns because of that. So what we're trying to do here is keep finding balance between how we can help our kids the best way possible without sacrificing our future. If you pull $10,000 out of your retirement account before you turn 59 and a half, you will be taxed on that distribution as ordinary income, and you will also face a 10% IRS penalty. So once that money comes out, you will have to earn all of that back before you even get close to even back in that retirement account. So if you're in your early 60s and you do this, you can avoid penalty because you've surpassed the 59 and a half barrier. But again, that money's out and could delay your retirement plans, hopefully not significantly, but certainly defray them. So I just want you to be careful if you're looking to help your kids. We'll talk about gifting here in the future, finding the right place to do that. And in many cases, a retirement account is the last place that you'll want to look. Using home equity without a clear exit plan, just like all giving to kids, if you're expecting that money to be paid back, that needs to be clearly stated up front. If you're using your home equity and you don't have a clear exit plan for how that's going to be paid back, in many cases, you could be threatening your ability to downsize when you want to retire, finding a new home situation, getting obviously a lot less equity from your property when you do retire or when you do want to sell it, those kind of things. So home equity can be a decent solution. In many cases, you're paying interest on that, so you need to understand what those rates are. A lot of home equity lines of credit, for instance, do have a floating rate. So while they got real high during our inflation boom in 2022, they've come down to a more reasonable level. But I don't think they're ever going back to those low, below 3% rates that many of us saw when we were buying houses 10, 15 years ago. So the interest rates of 5, 6, 7% are there. And if we do have inflation or anything turn the trend, you could see those rates go back up. And one thing that causes a lot of heartburn in families is what I'll call unequal help, or there's help among siblings that creates future conflict. I don't have a great answer for this, I'll be honest. But in many cases, you want to be fair with the kids, but help them understand you've got a framework and that your decisions are coming from the right place. And that in many cases, they're coming from your heart. You're trying to do the right thing for all of them. And balancing everything to the penny for each kid isn't always going to be the way it's going to work out best. However, you're wanting to be fair. You do have a plan. And the more that you plan for this ahead of time, the more that you'll find you have less, heartburn in the midst of this. So in all of these cases, we want to reframe things a little bit, that these decisions do come from the right place, but they don't allow us to go in and fix the adult child's problem. They're finding ways to fix that problem on their own. And the decisions that we're making are made with guardrails. And so that's what I'm going to talk about next, is kind of this permission to help framework that we've built. And it's centered around the permission to say yes strategically, the permission to say no without guilt, and the permission to use leverage at the right time when we feel that we need to have that money paid back over time, or whatever the case may be. All right, so when we talk about saying yes, that is what I'll call help that aligns with cash flow, not just emotion. So it's got a defined purpose. So we're saying yes to education expense. We're saying yes to some sort of transition. We're perhaps saying yes to a crisis. But these aren't necessarily saying yeses to something that's lifestyle based. So I'm going to use a bit of a ridiculous example here. Kid comes to you and says, Dad, I found a new car that I need help with the down payment. Super. I'm glad to see that you're out there shopping. What did you decide to get? An $85,000 Tahoe. Wow. Congratulations. That sounds great. Seems like you've got a good plan for a very expensive car. So I'm excited to hear how you're going to sort this. Well, what I was hoping you could do is help me with the down payment. All right, so this is a lifestyle expense that the kids come to us with that isn't actually needed in their lifestyle. May not even be needed in ours. So what we have to come back with this is, I tell you what, kid, we've sorted our financials, and this is where we can help. And so what they will learn from that is that the gaps of where we can help versus where they'll need to figure this out is going to require creativity. And so a better response, and I listened to a few podcasts that talked about this a little bit, is to say, I'm excited for you that you found this new car that you're excited about. What's your plan to find that down payment? Well, Dad, I thought you were going to help me. Nope, I'm not going to be able to help with the down payment on a Tahoe, but tell me some ideas. Let's talk about some ideas that might help for you. So we kick it back to them. We put the situation and the challenge of this problem back in their lap. Well, if I can't get the down payment from you, I can't buy the car. Sorry to hear that. That's obviously, I'm sure, disappointing for you, but what else can you do? What are some other options here? Do you want my help with this? And so in many cases then what we're seeing is that the kid's going to have to go back to the drawing board a little bit and say, all right, maybe the $85,000 Tahoe isn't the response. Maybe I'll look at a $50,000 used one. Sounds better. I'm still going to need $5,000 down to help though, Dad. Once again, I've looked at my plan. I'm not going to be able to help with that. What else can you do? So we're not fixing them. We're showing some empathy along the way. But there are things that do come along, like a transition expense or a bit of a crisis, that we can help and we can say yes. And so in those situations, what we want to do is offer up where we can help, be very clear, and also be very clear on the exit path of that. Are we going to help indefinitely? Are we going to help for a period of time? Whatever the case may be. So we talked a little bit about yeses and nos in there, but what we want to avoid when we're talking about a permission then to say no is repeated rescues, because it's repeated rescues that will create requests that are going to delay our retirement timeline. And so what we're hoping to do here is to replace guilt with clarity. We've planned for what we can help you with and what we can't. So for instance, when my boys got married, we gave each of them a sum of money and we said, we'll help. Behind the scenes, I spoke to both the boys and I said, if something comes up, some sort of crisis along the way, I'll help definitely with a limit to there. And of course, both of them did have some sort of emergency there where we had to help a little bit at the end, but that was fine. We agreed to that and things worked out fine. but that was essentially a yes with a no. We plan what we can help with and what we can't, and here's how that's going to work. So permission to set limits then without leverage, without expecting anything back, is when we do that time bound, where we say you have a certain amount of time to pay us back. So what I want to move on to now is talking a little bit about the conundrum around living at home. I looked up the word conundrum prior to our meeting here, and it is a continuing and difficult problem or question. And so if our kids are living at home, we're found that 57% of adults ages 18 to 24 do live with a parent. So this is something that we're definitely seeing more of, and definitely something that has, bear with me here, sorry, become more of an issue in 2026. So with these kids living at home, it creates a dynamic of, when are they going to move out? I thought I was an empty nester. How does this work? How does the kid feel about this? In many cases, this is lasting longer than we thought of, and from being a funny anecdote in a movie to a very difficult reality that we're all facing. All right, so what we found in the Pew study, along with this 57% stat, is that 72% of adults that are living at home do contribute financially. 65% of them help pay household expenses. 46% contribute towards rent or mortgage. And it's interesting, though, that 64% of the young adults say living at home helps their finances. Well, yeah, that makes sense. If they're living at home, obviously they're getting to save some on rent. A lot of kids I've found with clients and friends do transition at home for a little bit, especially when they're first out of school, until they find that job, so they can find the right place to live, those kind of things. And saving money on that rent can be a great way for them to get a good start. So by no means is this necessarily a bad thing. It goes back to our permission to help framework. We have a little bit of either milestone-based help or time-based, where we're saying, yes, we can help once that job is settled. Once you can qualify for a place on your own, let's get to work on that. So again, 64% of young adults say that living at home does help their finances, where only 27% of the parents say it helps theirs. So we're having two different experiences when they come along the way here. All right, so we're going to talk a little bit more now about smart ways that we can help, and what are some of the financial metrics that we can use that will help our kids along the way that also won't damage our future. So let's talk a little bit about gifting. If you're going to gift outright to kids, generally the best way to do this is with cash. You can sometimes do it with stock and those kind of things, but if you're going to make an outright gift to your kid, you need to make a few things in mind. There's an annual exclusion of $19,000 per kid per adult, and that is per calendar year. So if you're going to gift a gift to your kid, you don't want to do more than $19,000 per adult. So if there's a couple involved, obviously you give the $38,000 to the kid. If you were to make a gift larger than this, what's going to be required is a gift tax return that you have to file. And that's going to reduce your estate exclusion over time. So you don't have to get into all the details of that today, but just be aware of that exclusion. And if you're going to go above it, that you consult a tax professional to make sure you're doing it in the most smart tax-aware way that you can. When you're using these gifting strategies, you want to try to use your peak earning years before you move into retirement and or taking Social Security. Obviously, in your peak earning years, you've got additional disposable income, hopefully, and can help with those situations along the way without damaging your current living expense as well as saving for retirement. If you're retired and your only earnings are your portfolio and Social Security, as you can see, that might put you in a bad situation. So something to consider there. But keep in mind those annual exclusions, and if you're making direct gifts, in a lot of cases, cash is the best way. You can also give appreciated securities if you want them to have those securities and the appreciation that might come from those. It depends on your kid's situation and what they're going to be using the money for. The other way is that if you wanted to pay tuition for the child or any medical bills, if you do that directly to the institution or to the medical facility, that's not going to count against that gift limit. So that's a way that you can actually give to the kids without impacting that gift limit by paying that the university directly. Maybe it's a grad school gift that you're doing. You can pay directly to the school in that case. Or if they have a medical bill that didn't expect, whatever the case may be, if you pay the medical institution, that's not going to count against that gift limit. I'd also like to talk a little bit about strategically using 529 money. In many cases, you might have used college savings plans to save for your kid over the years. Perhaps now they're adults and they're out of school. Perhaps they're going to go to grad school. You can still use the 529 money for that. You can also transfer those dollars to another kid So if you have a kid down the road, I call this kind of the waterfall of 529s, where if the kid's still in school, you can change the beneficiary on that account from the kid that it is now to the kid that's still in school and use those dollars for them. You can also use for graduate education, like I mentioned. So if they're going to medical school, anything like that, you can still use those dollars up for there. There's also now a new provision in the 529 code where you can roll that money over into a Roth IRA with limits for the child, the adult child, as long as they have earned income, a few other things like that. So check into the rules of that before you do it. But in many cases, you can then waterfall that money into a Roth IRA and really set them up for a good savings plan for down the road. And again, that's only going to go for the beneficiary of that plan. You can't use it for a Roth IRA for you as the parent. So the Roth plan is also one where you could look to use Roth IRAs strategically for your child. I put this in brackets with some caution, though. The kid needs to have some some earned income that they've got some along the way. It needs to be below the parents' gifts limits, those kind of things. But what can happen is the child can get some tax-free money put into the Roth account. The Roth money would be taxed as it goes in from you, but it would sit in the account and grow tax-free and then grow long-term for them, and they would have that money as a tax-free bucket to use in retirement. So that would be a gift outside of the 529 that you could use as long as all of those stipulations are met. I would caution you also not to use your own Roth IRA money if you're going to be helping your adult child out. That's really set aside as a great tax-free vehicle and bucket for you. So you do not want to pull that out if you don't need to, and allow that to grow tax-free for you over time. All righty. So as we wrap things up here, I have a few things I wanted to give you. We've got a guide here that is called Helping Adult Children. And it's a checklist, and it talks about in 2026 some of the issues that I need to be thinking about if I'm going to, as my child becomes more independent. So we found this to be a really good resource that can help parents. It talks about what to do in case of an emergency. Do you have contact information of ways that you can help your adult child if there's a healthcare issue for them? What to do with if your child's still able to be on your health insurance at work? Do you need to revisit goals in light of your child leaving the house? The change of them becoming a dependent on your tax return to not a dependent on your tax return any longer? Is your child still driving and still considered a dependent? Has your life insurance changed? Your life insurance needs changed. All those kind of things are available in this checklist. So feel free to download that, print it off. If you want a copy and you can't grab it for some reason on here, please send us an email to will@pfwplanning.com, and he will get you a copy of that over there as well. Okay, so as we wrap things up, I want to talk a little bit about having conversations that don't blow up. Every resource that I listen to about this is talked a lot about not lecturing and not putting our kids in a position where they're going to feel defensive. It goes the same with our aging parents. And as fate would have it, our next webinar is going to be about how we help our aging parents and be part of that journey with them. And so part of these conversations then are definitely showing empathy, understanding the problem, saying, I get it. I've been there in some cases. I've seen friends and clients go through it, whatever the case may be for you. But we want to give them anything but lectures. And so in a lot of ways, what they suggest that we start with is, here's what we can help with. So there we're starting with clarity and not emotions. We talked a little bit about weddings. And so rather than just an open-ended wedding, in some cases, our kids had spreadsheets put together that showed us what was expected. We knew where we fit in that, and they had a clear plan. Makes you feel good about helping when you know both there's an end in sight and that they have a plan for where those funds are going to go for. In some cases, we want to come across not as judging them, that, what are you thinking? Or why did you do this? Or what are you going to do now? That kind of judgment and reflex can cause a lot of heartburn with the kid, really cause them to push back. And then all of a sudden they're in a worse position and we're not really able to help anymore. We also want to avoid the rescue reflex. This is one I'm super guilty of. As soon as the kids come in and need something, I'm like, how do I fix it? How can I immediately get in and get involved and help them with the situation? So we don't want to over-explain. We also don't want to be defensive. They could say something, well, you bought a house when you were 25. Why can't I? Well, because I was smarter with my money than you were. you can see where that's going to go and take us down a road that isn't going to help. So in some cases, then it makes sense too to bring our adult kids into our planning. And so we can say, listen, we've been doing a lot of planning for our future. And what we're looking at is X, Y, and Z. We want to retire at 62. We want to retire at 65. We do not want to be a burden for you later in life. And so if we help with this now, it's going to change either that retirement goal, or we are going to need your help at some point with housing, whatever the case may be, theoretically. So understanding what your plan is and why you can't help is a good one. But also then to say, we can help, but this is why we're putting a barrier on it, because our plan says X, Y, and Z. This is how we're able to do that. So what does it really look like when we're helping our plans? We want to support their independence. For me, this was a big challenge when the kids were younger. They started driving. I just got very bitter that they're getting so independent, leaving us behind. But now they're adults. The more that we step in and help, in some cases, we are not supporting their independence. So we want to do that. We also need to be thinking about ourselves here. We want to protect our own dignity, our own freedom for later. I mean, your retirement, what's coming up for retirement is not a backup plan. It's a responsibility, and it could become theirs in the absence of a partnership mentality with all this. So the kids, they have a runway. They have a lot of time to fix financial problems that they make. Ours, however, is much more limited. And I think as a family, we have to really start acknowledging that in some ways. I wanted to put up a chance for all of you, if you're interested, in having a 15-minute call with us to talk about a plan for your adult children and helping them out. So if you've been having either a bad situation or you're trying to get organized as an empty nester and you want to know some of the steps that we could help you take, we're happy to do this on a consultative basis. We won't charge you anything. We just want to help where we can. And then if we find a way that we want to work together in the future, great. We'll talk about that at the time. But we wanted to offer up that call as a way for you to get more details, learn about ways that we might be able to help. And as you can see from the offer there, you can schedule that call. Sorry. Up on your screen now. So we've got that published for you. I mentioned a couple resources. There's a podcast called Bite Your Tongue, and there's a couple of folks on that bring on some great guests to talk about just this topic. You know, how to help your adult children, how to get involved in their lives without being overly involved and also not threatening your future. And the topics vary from emotional issues, for sure, ways to communicate. There is some financial topics discussed in there, like some of the ones that we talked about today, but I did find that to be a great resource. So on your screen, you've got a chance to pull that checklist down if you'd like to. We've also given you a chance to schedule this call. I'm going to log over into the Q&A to see if we've got anybody there that's got any questions. You can definitely plug that in there if you do. And you can also always email us and reach out. I've got my contact information for the office here on this slide, where you can reach us, our website. We have a lot of resources, including a free copy, if you want it, of my book, Empty Nest Full Pockets. We talk a lot about these issues of the kids transitioning into adulthood. And then also you can email us if you'd like to set up a call or you have any specific questions about today's topic that we can answer for you. So thank you all for joining us today. As I mentioned, next month our topic will be helping our aging parents as we go through that difficult transition, not threatening our retirement, finding balance like we talked about here with our adult children today. So thanks for bearing with us. I apologize for the technical difficulties. The internet gurus are always at work. I think it's because it's so darn cold. And it's the cold is making the internet grumpy, and that's what's happened along the way here. So appreciate your patience and your joining us today, and look forward to talking to everybody here in the near future. Thank you so much.